Welcome to the Dividend Talk podcast, episode 94. Which is the best to buy right now, Unilever or Procter and Gamble? Hey guys, welcome back to another episode of Dividend Talk. Today, myself and European DJI are going to chat about Unilever and Procter and Gamble and decide which one we prefer to buy at the end. All that and more. See you on the inside. Hey, European DJI, it's Good Friday. How are you feeling?
I'm feeling really well, I must say. Looking forward for a long weekend. Weather is not too good, but I still hope that will change. In Poland, Easter is of course a really big day. Lots of church visits. Actually, it's one of those. I believe even for me most nice holiday when you think about Polish traditions here.
Yeah.
But tell me, how are you doing? Because you sound a little bit
I, I,
coffee.
I'm a little bit bunged up. So the Chinese flu, COVID, has finally caught up with me. I'm not too bad, just a little bit chesty, more tired than anything. But look, I thought I'd be a lot worse. Luckily, I got the milder strain, so it's all good. I'm well enough to do this podcast, so we'll power on through.
Come on, you
But
just look like Hercules, and you're a young god, so just more healthier than I am.
ah, it's the whiskey. I told you, it's Irish whiskey. It keeps us strong over here.
For the listeners that are wondering what the hell are they talking about, it's a bromance. But look, let's talk a bit about news of the week because this was crazy. And we have two topics, and you tell me which one do you want to start with? Alibaba or Twitter?
Let's start with Twitter. I mean, we mentioned it last week, and where was it going to go? But Elon Musk is going all out here, isn't he? He's trying to force a hostile takeover. It's not going down too well with the board.
Yeah, and today he even mentioned like he's not even sure if he could fund it, if he can get the funding secured. But also, then the board is trying to take such a poison pill so that it will be hard to take over like that. I mean, this is awesome, right? I mean, it's not a dividend stock, but for me, this is really like popcorn time. I mean, if Elon Musk's, yeah, it's just pure entertainment.
It's brilliant entertainment, and to be honest, I've never heard of the poison pill defense system until today, and
Yeah,
apparently it's not great for the company. But I mean, Elon is he's just
yeah,
I don't know, he's just batshit crazy, isn't he? He just doesn't care. But what's interesting now is you're going to see all the media, because it's going to affect a lot of people, right? And there's
yeah,
obviously a lot of people hung up in this or involved in Twitter and freedom of speech and all this,
yeah.
and we might start to see the narrative surrounding Elon change. He mightn't
Yeah.
be the poster boy in the media, but then the knock-on effect of that is Tesla, isn't it? That's going to get affected. So
Yeah.
it's going to be interesting sitting back watching it. But I mean, I clap my hands to him. I mean, he's a must follow on Twitter. I don't care if you follow nobody else. Follow
Yeah.
Musk. He's just
Yeah.
brilliant. He's just brilliant.
And what you just mentioned about the poison pill, like several years ago, Warren Buffett and 3G Capital wanted to acquire Unilever, right? And I don't know exactly anymore the details, but also Unilever at the time pulled up a whole firewall, let's say, to prevent the hostile bid. And I think that's also one of the reasons why Unilever at that time lost a little bit also of the, let's say, the additional multiple just because it's a hard takeover bid. Yeah.
Yeah.
So there are things that boards can still do to prevent themselves from hostile takeovers.
Yeah, which I mean, is fair. It is fair, but I mean, you have to ask yourself what's best for the shareholders. What would they prefer in
Yeah,
this situation? I don't know. I really don't know. I'd imagine maybe the popcorn loving retail investor like us might say, give it to Elon Musk. But I'm
Mm.
sure there's pretty serious shareholders there that have a lot more to lose and a lot more money invested that might have a different
yeah.
opinion. So I think it's
I
right that they can defend it and not just let him take it over the way he's trying.
For me, it's really simple. I only like hostile takeovers when I agree to them.
Yeah, exactly, exactly. But I mean, what I love about this is it's just so public. I mean, he's
Yeah,
and he's using the platform that he's trying to take over
against them.
to
Yeah.
get against them. It's absolutely brilliant. It's brilliant.
Yeah, and then we have an, I believe, 97-year-old guy who sold half of the stake of Baba versus the Daily Journal, and we are Baba shareholders, right? And what are your thoughts about this?
I mean, who I feel sorry for, and I know that there is investors out there that buy based on Warren Buffett or Charlie Munger or any large institutions, but they follow these guys. And we saw him buy a large, well, not a large stake, large for us, but a relatively small stake for him in it, and then he doubled down on it. So people got bullish. The stock, I think the stock price bounced. It was around 90, went back up to 119, 120-ish. And now this guy sells half his stake. I mean, what the hell is going on there? I don't know his reason to do that in such a small amount of time. I don't know what has changed.
Yeah,
Something has changed. Maybe he made a short-term bet, um, and maybe he purchased it when it was lower and got out when it jumped up, was it 10,
yeah.
15%. But I don't know what has changed in his mind,
Well,
really.
there's a lot of speculation. First of all, there's new management at the Daily Journal. Secondly, there is even suggestion of a potential margin call, which I find hard to believe. There are people that speculate that it might be tax harvesting, but usually you do that at the end of the year.
Yeah, it's not tax
Uh,
season.
yeah, and but still, you could still do it. Of course, there are people that are suggesting that he's moving to the Hong Kong shares. In the end, nobody knows. What I just want to put here is a strong warning. I like really a lot the YouTube channel of Everything Money. They are focused on stock analysis, valuation,
Yeah,
and every time when they were discussing about Alibaba, they were saying this guy was saying like, oh, Munger buys it, has done his homework. Who am I to doubt Munger? He knows more about China than I do, so it must be fine. Yeah. So and then now I said Munger somehow reduced his stake, and then they go back again to the pure numbers, and and they are right with their. I mean, I follow their line of thinking. Let's say with the numbers, but I always get an allergy of people recommending like, oh, you should do this because Munger or Buffett or Monish Prabhai bought it, so then it's safe. Yeah, I don't buy
yeah,
this because it kind of you kind of how you say it, lack then some certain self accountability and play a bit the victim card as well if it can go wrong. And I think if you invest your money in the stock market, you need to own it, and you need to own your own mistakes, and you need to own your successes as well. Likewise, so
well, half the problem is if you follow these guys, or if you follow anybody, you're getting delayed information, right? And
yeah,
I don't know how long it is before they have to file from when they
yeah,
buy it. Like it could be a quarter, so you could be
yeah,
a quarter behind these guys all the time.
yeah,
Information in this world is fast. It changes
yeah,
quite quickly. These guys will get it before us. We know that, so
yeah,
they will get it before us. But like we'll get in too late. We'll get in after
yeah,
they've made the money, and then we're going to sell after they've made them, and we're going to lose a
yeah.
lot more money. So I think following anyone is dangerous. I think it's okay to look at these guys, look up to these guys, but you
I
need.
like the channel because it talks about stuff. Although after a while you get it right, they never go. They often look at numbers. They don't even understand why the numbers are different. They start guessing, and I think like, just Google the news and it's on the front page already. But okay,
Yeah,
but
yeah,
I for me it's entertainment and inspiration because
mm,
often there come stock ideas, right?
yeah,
But then still you need to do your own homework because conviction is what you need when there's a stock market crash.
yeah,
And if you're at that moment not having the conviction because you just copied an idea from someone else, not knowing what you did, you are more likely to respond emotionally.
exactly.
Specifically, if that person that you were following also responds emotionally. So,
Yeah, and I think you hit the nail on the head. Accountability in yourself is probably the biggest thing. It's a lesson I've learned, and you're going to hear about that in one of the questions later on anyway. But look, I I'd love to know what was inside his mind. I'd love to know why he sold half his stake. I'm pretty happy I got out of my option trade at the time. I know I took a loss, a reasonably large loss for me. at the time, but I'm glad I did. I'd probably be looking at a larger loss if I had it now. But I still own 20 shares in my Deguira account. I don't
Yeah.
even look. I don't even look at it. I don't care where it goes between now. I'll look at it in 2 or 3 years and see what happens. But um,
Well, I'm like you. I'm like 40 or 50% down. I wanted to double the money in 3 years because it's not a part of my dividend portfolio, but it's 10% growth. So if I had to double, then now I probably need to quadruple
yeah,
in still 2 years.
yeah.
So I think this will be one of my failures in
It.
2 years from now.
Do you know what? It might be a handy tax harvesting tool for me come tax season at the end of the year
Yeah.
because I can offset a lot of my dividends with
And
the
I did
losses.
that already because I sold in December. I sold the how is it the American listed shares for the Hong Kong share and replaced them with the Hong Kong
Ah,
shares. So
yes, I
technically,
remember.
it was tax harvesting for me.
Yeah, yeah, I remember.
Yeah,
I remember that was one of your reasons as well. So no,
yeah,
that's a
yeah.
fair point. I won't be doing that if I sell them. They're gone. I'm not looking not looking at them again.
Yeah, you need to. It's like an X, right? You need to leave it behind you. Now get back to it. Okay, so let's go to the main topic. And I really wanted to thank one of our listeners here because this person reached out to us and he said, like, it would be so cool to hear you sometimes do kind of a stock battle compared to stocks with each other or take the top three of certain countries. So thank you for that idea because I think it's a nice addition to the podcast. And today we'll do for the first time. And I thought we should do something like about Unilever and Procter and Gamble because if we are looking at it as a dividend growth investor with a valuation edge to it, the Unilever story is so different from the Procter and Gamble story,
Yeah.
but it doesn't answer then the question yet, which one will we buy? So I'm very curious to you. I know you will talk a little bit more about Unilever. So what are your thoughts about Unilever and such at the moment, and how do you look at the company?
At at the moment, my thoughts around Unilever in the short term are quite negative, mainly around the management. We seen this fiasco with the management recently, and making big announcements for acquisitions and then backing off because of pressures from shareholders. We also seen a large price drop. If you remember, a couple of months ago, they're up around $50. They dropped shortly down to about 44. Now they're hovering around 41. And I think you wrote an excellent article on that. You were talking about there was margin pressures, there was margin
Yeah.
reducing, and so on. So I think that's all valid. I just regret buying them. I think my average price is around €50.
Hmm.
And at the time, I thought that was actually a decent price, and I still think it is. But right now, if I didn't have so much of them in my portfolio, I would now be looking to get into them again. One of the things I love about Unilever is, aside from their management, I think investor pressure here is going to force their hand a little bit. But they've got huge brand power, don't they? Like if you just look at some of their brands, Dove. If I even look at my press, you got Dove, you got Hellman's, you got Noah, you got Magnum ice creams. I have all this stuff in my house. The spray links we use over here,
Hmm.
they've got like huge brand power, and that's not going to go anywhere anytime soon. There is concerns with inflation. Obviously, can they pass all that onto the customer? I bet they can, because these are products that people need mainly. There is some products maybe they can't, but I think as a whole, they will be able. Maybe not at the pace as inflation is going right now, but over time, it will certainly catch up with them. But long term, I'm a little bit more bullish. It's just short term, the negativity around the management. I'm just unsure with the management at the moment. It's my biggest worry.
And what are your thoughts about their approach, like more favoring stakeholder management versus shareholder management? And what do you feel about how they deal with Ben and Jerry's, where Ben and Jerry's can be effectively doing whatever they want and take a stake against what is it, Israel or something like that, and about giving mayonnaise a new purpose?
Yeah, so I mean, stakeholders over shareholders has both pros and cons, doesn't it? And I don't disagree with it a whole lot because normally these guys, these stakeholders, they have a lot more money invested than we do, and they want to get the most returns possible. And to do that, you need to do good by the company. They probably have a lot more experience than say I would, and how a company, a direction a company like this should take. So I don't necessarily have a problem with that. With Ben and Jerry's, it's a bit of a crazy one, isn't it? Because Ben and Jerry's just seem to go out and just say what they want. Like they are a huge brand, and I don't know. It's like a professional sports athlete. Like when you're in front of the camera, you're an idol to all these people. You have to watch what you say. You can't just
Yeah.
like I might think it right, and I can say it because like who's following me. But man, you're a big brand. Just keep your nose out of politics because it's one surefire way to, I mean, tank a company because all of a sudden you're upsetting politicians, major players. They get a discount to your company and they can pull the
Well,
wool from under them.
I think the issue with Ben and Jerry's management is that, and this is term wokeness, that
Yeah,
they're so overly woke that they feel like they know best how to think about the world, right? And when you start having this kind of thoughts about it, which might be correct, I leave it in the middle, but you start becoming political,
but
yeah, and that's the issue with such a company. Then,
maybe they do. Okay, maybe they do, but it's not Ben and Jerry's that have those thoughts. It's people. So let those people say it behind their own face. Don't go
yeah,
behind Ben and Jerry's face and say it. Do you know what I mean? Let the business be the business, and you go about your business and do your own thing. My problem is I don't know what Unilever can. What did they do there? Did they pull rank? Did they tell them to shut up? Or I mean, I can see them eventually spinning these guys off because they probably cause
yeah,
them so much of a
yeah, yeah,
headache. And it's probably what I would look to do. Just get rid of them and
yeah,
let them make their own mistakes.
yeah, definitely. And maybe I can tell a little bit about Procter and Gamble then, because for me, Procter and Gamble, I mean, and Unilever, those are the Pepsi and the Coca-Cola of the consumer staples
Yeah.
when you think about these kinds of goods. And for people that actually know Procter and Gamble probably as a dividend stock, but what they actually produce, it's like Pampers when you think about the diapers, Ariel, Draft, all of these Tide in America as well, right? Bounty, Always for the female listeners, Brown, Gillette. I mean, these are really really big brands, Head and Shoulders, right? So top brands. And what I really love about Procter and Gamble is more that they're focused on shareholders versus
Yes.
stakeholders. So it's really still American capitalism, not like Unilever and Danone, and the path they've chosen. But what I also, how you say it, like, is that they have been over the years always been able, because of the brand power, to pass on the price, or hiking their prices beyond or above the rate of inflation. Of course, now with a 7 to 10% inflation, I think that's almost impossible for most of these companies.
Yep.
But generally, they have been outpacing inflation a lot, and this is for me a really important factor when looking at companies like Procter and Gamble. And then, this company has 66 years of, how is it, of dividend growth. I believe they paid dividends for 128 years in a row. I mean, this is just so iconic. When you think about dividend growth investor, I think Procter and Gamble is always a stock to keep an eye on. Whether or not it's rightly valued, we'll get soon to that.
Yeah.
But for me, these brands and their worldwide presence and their laser focus, I find it also quite efficient company, is something really, really that intrigues me, and it's just an A-class company for me.
Yeah.
There is a thing that I think people need to be aware of, and I believe also a little bit applies to other consumer staples, probably also to Unilever, is that 2020, those numbers and the free cash flow numbers that you saw there, you need to take them with a grain of salt, because a lot of that sounds like a one-off. People were in panic mode, bought a lot. People were at home, bought a lot. So these are sales and free cash flow numbers that you cannot extrapolate into the future and thinking this is my baseline. So you need to really take that into consideration. But it also shows just the power of where people go to under stress, and then you go to these kinds of companies.
Yeah. I think if you have to compare the two companies on brand power, just brand power alone, if you know nothing else about them, I mean, a lot of Unilevers are huge in Europe. It's obviously a European company. I'm not sure how many of them would be that big in America. Whereas with Procter and Gamble, their brand power is big in America and Europe. It's more, I feel it's more worldwide,
Mhm.
particularly like something like Pampers, for example. I think everybody would know that. But if you were to
Yeah.
compare, I don't know, say Hellman's with
Mhm.
Unilever, I don't know how big that would be in the United
Yeah.
States.
I'm not from the United States, so I honestly can't say that, right?
Mm.
Um, but I think if I remember correctly, generally, these are both brands. I say comes from large brands, but I think the margins of P&G are just a little bit better. I think they're just more cost efficient. But from a brand point of view, I treat them similar. They just have iconic brands. They target maybe a little bit different geographies where they are better versus the other. I believe Unilever is also very big in the US because we just spoke about Ben and Jerry's as an example, right? But P&G also did some portfolio restructuring quite effectively,
Yeah.
and Unilever is still struggling with that. They're still not rid of their Lipton business, as an example. They are talking about already for 5 years that they want to get rid of low margin business, but they are not executing on it. And P&G did this really quickly and relatively well. And that's for me comes back to what you said in your opening about
Management.
Unilever management.
It's management. Yeah.
Alan Yopi wanted to buy the consumer business of GSK for insane price. I mean, this guy should have already been gone.
I don't believe he knows what he wants, what direction. I think he maybe thinks he knows, and he's listening to lots of different sources and just trying to throw a dart at a wall and see if it sticks. But I mean, they've been talking about this, haven't they? They've been saying a lot that they're going to move to
Yeah,
high margin, but there's no evidence of this actually happening. Like like it's easy to say it. But
yeah,
you need to do something about it, and
yeah,
that's why short term I'm a little bit more bearish than I am bullish on him because
yeah.
I just it's the direction. I don't get a sense that he yet knows what's going to happen. But I would not be surprised to see a change of hands
Yeah, but he
pretty soon.
damaged a lot already. He took the company Unilever out of the Netherlands and moved it to England.
Yeah,
So that's for good. So that's an action he did.
yeah,
And then mediocre results. I mean,
yeah.
from a Dutch person point of view, there's sentiment there, right?
Exactly,
What? Yeah,
exactly. Yeah, exactly. And it would alienate a lot of Dutch investors because of that. Because obviously I talked to you, I talked to a lot of Dutch
yeah,
investors, and there's always a sense of I would say national pride, particularly in some of the companies. Shell was another one, and it was hard to let go of the Royal Dutch Shell, but it's baffling. But I would be surprised if he's still there in 12 to 18 months. I really would. And
yeah,
and and someone that comes in has a really low baseline
yeah.
that they can do nothing but up the way. Do you know what I mean?
Yeah, yeah, yeah. So, and then if we look then more about because this is about the business, right? And
Yeah.
I believe you should always first start to talk about the business before looking at the fundamentals and technicals. So the difference is really simple, right? 2.3% yield for how is it for P&G, or 4 point what is it 1% for
Four
Unilever.
4.12. Yeah. Yeah.
Yeah.
So
So what are your thoughts there now, right? What do you think about Unilever? How do you look at the fundamentals, let's say, of the
I,
metrics?
I mean, straight away based on yield. And look, we never make decisions based on yield. It's usually the last thing I'd ever look at. But you look at the yields, and I think it outlines exactly
Yeah.
what we said about the story so far. We've got a higher yield in Unilever because there's more risk there at the moment.
Mhm.
They're a
Yeah.
little bit directionless, and the management are a little bit all over the place. Whereas Procter and Gamble, as you said, they're slick, they're a well-oiled machine, they're shareholder friendly. 128 years of paying dividends, 66 growing dividends. So I mean, you know what you're getting. But the problem
Yeah.
with that is the price is going to go up, which is going to drop down the yield. But looking at just purely numbers, Unilever doesn't look too bad. Okay, it really doesn't look too bad. So I focus on the growth figures. So we have dividend growth, free cash flow growth, revenue growth, and earnings per share growth. Okay, so typically what we look at, revenue growth is quite slow. It's 3.4%, in and around what you probably expect from a consumer staple like this. The earnings per share growth is 5%, which is not bad. And then you got your free cash flow growth, which I think is quite impressive, is nearly 7.7%. On top of that, then you got your 5-year dividend growth, which is also 7.13. So it's keeping in line with its free cash flow. And I really like that. I do really like that. So like you've mentioned, 66 years with Procter and Gamble. These guys have got 55 years, and they show that they do actually increase their dividends in line with free cash flow. So they are a little bit shareholder friendly when it comes to dividends. And I was nicely surprised when I seen those numbers.
And but do you think that the dividend is safe?
I think so. Yeah, I think so. Looking at so the first thing I look at from the safety is the growth numbers, and if I saw the free cash flow outweighing the dividend, I'd be concerned. It'd be a red flag. I would like earnings to be a little bit higher with it. I'd like earnings to be around 6-7%, but I'm not. I mean, look, we know earnings can be manipulated and numbers can be pulled and dragged. So free cash flow is my concern. And then we look at the payout ratios. Earnings per share is borderline at 74, but free cash flow is 67. It's under my 70% threshold, just about, mind you. But we can see that they are growing in line, so I'm not overly concerned. So for me, it is safe. Now, we do have a shared screener where we run the numbers, and the numbers don't tell us that directly because we take lots of things into consideration. What we take in credit ratings, we take in the growth numbers that we said, debt to equity we take in, and so on. And actually, what our screener tells us is that the dividend safety is questionable. Um, so I mean, take what you will from that, but I personally think it's safe. But if you're to run just pure numbers and based on our spreadsheet, it gets a rating of between 44 and 55 out of 100.
Yes, and I think I said I think Unilever deserves a lot of credits for their dividend growth history and
Yeah,
such, right? And we can also look at the data and see that it just on many metrics it just didn't score the a certain points because it was like really really just off, right?
yeah.
But you know, it's a metric. It thinks in zeros and ones. But still, I think I do believe that the dividend is safe. But if this continues another 2 or 3 years, then I believe not anymore. Yeah, this weak performance of management. So that's why I think it deserves to be questioned here. I just don't see anything happening on the short term.
But I think there's savvy there in the raises, the dividend raises will be in line with their free cash flow. And if we see that
Yeah.
declining, I would expect to see that. I don't think these guys are going to cut a dividend. I really
Yeah,
don't.
but watch out now with these inflation numbers, and if they're not able to manage the supply chain well, and if they are not able to, because you know the stakeholder management, they will also be sensitive to salaries and all these kinds of
Yes.
things. So if they are going to take the cost on themselves, it becomes a different story really, really quickly.
Actually, that goes back to your question earlier. These are more stakeholder friendly than shareholder friendly, and we've seen this CEO buckle the pressure already. And if they start saying cut the dividend, cut the dividend, cut the dividend, then yeah, maybe you're right. Yeah. But how about Procter and Gamble now? How do you
So
see these
first
guys?
of all, yeah, Procter and Gamble has for me one of the safest dividends in the consumer staple sector, right? Here as well, payout ratios are around 62%. The average growth numbers are between 6 and 8%. These are just like clockwork numbers. If you think about it, if people design their dividend growth portfolio, usually these are the kind of metrics you want to put in to see from a company. Debt to equity, nicely 50%. Interest, really well covered. 5-year dividend growth rate of 6.4%. And in my opinion, the growth prospects are also quite strong. If you then look at, I say, just in general, right? I think the story here is a story of valuation because the price to earnings currently is around 28. A forward PE based on the estimates that I took is 27. Also, the price to free cash flow 27. So it is just really, really for me a valuation issue because this company, you know, a 28 PE, you want to see like a 15% growth or something like that. It's not hitting those numbers. Yes, in the last year maybe because of COVID, but generally not. So for me, these are heavily overvalued. It's not something I want to pay for. And in a zero interest environment, yeah, everything can be
Yeah,
having high multiples. But this has already been changing quite rapidly. So honestly, if I take my fair valuation here as well, I believe that if you take a terminal multiple for the high quality business of 18, and you think about, okay, we'll continue growing in the next 5 years with 8%, and then thereafter with 5%, and you always take a little bit less 5 years next because you don't know effectively. Discount rate of 10%, I believe the fair value is $106 and it's currently trading at 158. While if I would look at Unilever, we know our fair value is around 40, high 39s. So
Yeah.
if I would have to choose now today, I would buy more Unilever because I think the valuation is just better. But I also have lower expectations towards the growth for Unilever. Procter and Gamble is just too expensive for me.
Yeah, it is. It is too expensive, and it all comes down to the risk that I mentioned earlier. There's obviously a little bit more risk there with Unilever, which is why they're closer to the fair value. Actually, we have a couple of different scenarios. We have the baseline, which, as you quite rightly said, is around 40. But we also have the bearish model where we use a terminal multiple of 13, a growth rate of 3%, and a discount rate of 10, and it's closer to €31. So I believe that the fair value is actually between 31 and 39, somewhere in around that. I would, based on these two companies right now, if you were to force my hand, I would pick Unilever right now. But I would hold caution for the time being. I actually think the price is going to hover around where it is. It might even drop a little bit lower, and we might get it at a fair price. The question is, and I know you've got a full position, but the question is, if they do hover around that €31, I think I'll find it too hard not to buy him again.
I don't have a full position yet. I have a large position, but I could still increase. I think it's like 65, 70% filled. And I'm like you. I'm a little bit concerned about the quarterly earnings report, and they don't even give a report. They give a sales forecast. So we will
Yeah,
be in the dark until July with this company.
yeah,
So we will hear some sales numbers, and they will talk a little bit about margin. My expectation with this inflation shock that we're seeing now, I think they will get slaughtered.
yeah,
That's my thinking. I wouldn't be surprised if we see a 10% decline because investors will be, I said, punishing them even harder because of their weak performance over the last quarters.
yeah. So they could well come close to that €31 valuation, but at that point, you have to ask yourself how low can they go after that?
Yeah.
It's. I mean,
I
to
would be a
me,
buyer below 35. I would really start filling my position because I believe that this company is bigger than the CEO. And if the price drops there, I think the CEO is out and it will be replaced by I hopefully a more competent CEO. And
yeah,
we saw that with Danone. I was studying Danone today. This new CEO is really on it. He's laser focused, sharp in his commentary. That's what you need. And yeah,
yeah, yeah. Well, I'm putting my money where my mouth is. I'm saying this CEO will not be there in 18 months. He can't be. He'll be gone.
yeah,
Be
cool.
gone.
Well, thank you. I think we come to the same conclusion. PG better run business than Unilever. Unilever better valued right now. So if it comes to spending money, we will go for Unilever, right?
Yeah, I'm prepared to take that added risk.
Yeah, exactly. So I think it was a really great idea from one of our listeners to do this. I really enjoyed this to study both companies and to compare them a little bit. Specifically, that these are companies that are often mentioned. So please let us know if you like this as well. If you're listening, let us know on Facebook or on Twitter because it might motivate us to do this more. It's a tryout, so please give us feedback. It would be great to hear.
Awesome. Now we'll get on to our listeners' questions. There is a ton of questions to get through. I don't think we're going to get through all these. Thanks a million to everyone for the questions. We'll get through as many as we can, and any that we miss, we will get to next week. Um, so the first question is from Paul, and he asked us: is that he's looking to diversify his portfolio, and he's looking for some materials dividend growth stocks.
Yeah, I own both Rio Tinto and BHP Billiton.
Yep.
I like both. You need to know what you mentioned earlier. We're at the top of a cycle. On the other end, there's also really supply chain issues, resource scarcity, high oil prices. So I can imagine that these stocks will still do longer, a little bit better, but these are cyclical. So um, I wouldn't be able, Paul, to give an advice here. You really would need to do your own homework, but I can just say I own them, and I own them because I really like them. They fit well in my portfolio.
Yep. APD is another good one to look at, and Sunoco, I believe, are two more if you want to look at those. Uh,
Okay. Yeah, I got another question via my blog because we have a person. His name is Lars. He is not on social media. I think that's very wise because you lose a lot of time on that. And he's asking if we could do a review on LYB stock, so ticker symbol LYB, which means Lion. What is it? Lionel Base, something like. I always struggle with this name. Do you have some? What are your thoughts about that one?
Yeah, there was another question I got last week on this, and I think it was out of my emails that I missed. It's a company that I owned briefly. I remember when I spoke about at the start of the show following others, and you're always behind information. So this was one of those stocks for me. I was following Dividend Growth Investor, which I've spoke before at the start, and I owned about 5 shares of these. And then at the time when I was changing over my portfolio, or really starting to understand what's in my portfolio, I read Google these guys, and one of the first things I seen was they declared bankruptcy in 2009, and I just went, screw that, they're gone. Right, straight away, just I'm getting them out of my portfolio. I don't care. So I sold them. I sold them at the time. I be, I believe. I mean, I believe they've really turned a corner there, and they're really more focused on dividends. I haven't given them enough time since. They are, I think, from what I remember, the world's largest producer of polymer compounds and so on, which I believe is quite important. But it's also, as you spoke about, cyclical. It's also highly sensitive to the economy, and I think at the moment it's flying high. Um, uh, but I just can't get my head over that when. So I wouldn't like to be buying them now, and the reason is that bankruptcy, because everything is going good now, but when it goes down low and when they go through the bottom of that cycle, are they going to declare bankruptcy again? Can they come back from that again? They'll probably be 100% going to cut their dividend. So I prefer to buy these guys at the bottom of the cycle if I was going to. Um, but as I said, I haven't looked into these companies past the whole bankruptcy thing, so don't take my word for it. But yeah, that's my take on them.
Cool, thank you. So then the next question is from John Barraclough, and he wishes us a happy Friday, Good Friday. And he's asking like, how much are we considering dividend cover when looking at our current and potential holdings? If one or less, do you disregard the stock?
Dividend cover, are you talking like payout ratios against free cash
Yeah,
flow?
that's what I understand as well.
Yeah, so I look below 70%. Like 70 is my limit. I prefer them to be in around 50 is my preference, but I've allow up to 70 once, like I mentioned, once the dividend is growing at or below the rate of free cash flow. That's
Yeah.
my biggest thing.
Yeah, same here. And then there are some exceptions. For instance, when you think about cyclical stocks, yeah,
Yeah,
when the
yeah,
earnings are low, you have more tolerance. But also, real estate investment trust, they need to pay a certain amount.
yeah,
But generally, that's the thing. Yeah,
yeah.
cool.
So Billy Pritchard has asked us, at the moment, money seems to be piling into pharmaceutical stocks like AbbVie and Merck. Are there any undervalued sectors you guys like over the last few weeks to search for good value?
Yeah, for me, the insurance sector, the yields are really strong there. Specifically, the European insurance stock sector, I think, is underinvested or underappreciated. And typically, when the yields, interest rates go higher, then I said the insurance sectors benefit from it because, simply said, they use the term of float, right? They get money from the customers. They need to wait, let's say, a year before they need to pay it out, before there's a claim, and in the time they put it in bonds and everything. So bonds, of course, went really down lately, but in the long run, it should do well for them because they get better interests on it.
Cool. Um, we got a question about tips for dividend growth investors who invest small amount of money, like 50 to 100, and then some other guys have 300 to 500. What I would say is just forget about how much money. I know some people say they're putting in thousands, some people put in tens of thousands. It doesn't really matter. I think the principles stay the same. When you're investing a smaller amount of money, I think fees become a little bit more important. So just have a good discount broker, the Gyro, Interactive Brokers, Trading 212, so on. Just keep your fees minimum and just keep it the same. It doesn't matter. It doesn't matter what you invest once you have a long term plan. you know where you might end up after, say, 30 years. The
Yeah.
dollar amount, euro amount doesn't matter.
I would really advise to go in this case. I would really advise to go with trading 212 because you can also buy fractional shares. So if you have only 50 or €100 a month and you want to buy Microsoft, you cannot do it at the Hero or Interactive. Well, maybe Interactive Brokers has now
You
also
can.
fractional shares. Yeah.
Yeah, you can. Yeah.
But trading 212 as well, it comes at zero commission. Doesn't mean it doesn't cost you money because, for instance, the spreads are not so good maybe as at the hero or something like that, but still you can invest it and you can let it compound, so you can do automatic investing specifically if you have small amounts to invest. But to your point, it should not matter at all from your investing strategy point of view.
Okay. Marek has asked us to talk more about the 4 tiers where you divide your stocks.
So Marek, there's also, if you go to europeandgi.com, you will see also there's an article called Portfolio Allocation Strategy. It explains it all. But simply said, the tier one stocks are the ones that are really foundational for me that I want to build my portfolio on. Companies listed here are like Nike, for instance, Microsoft, Apple, those core stocks. Most of them are heavily valued right now. So that's why you don't see me really buying them. Tier two is the second layer. So by the way, tier one is 4% allocation, target allocation. Tier two is 3, tier 3 is 2, and tier 4 is 1. Tier 3 and 4 for me are more like the Bus Fs of this world. I don't want to have too much in their portfolio, usually a bit higher yield, but also low growth prospects, more mature businesses and such. And that's why I use it. In total, I use 40 stocks because it's really hard for me to manage 100 stocks. But to be honest, I've got 45 stocks in my portfolio now, so I need to do some spring cleaning in May again. I hope this helps, Marek. But there's an article on my blog. Just Google it on European DGI and you will find it.
Cool. Matt has asked us, have we got any special plans for the 100th episode? Maybe we could add an edit button to the podcast.
So we don't have plans yet. We didn't discuss, but somehow what we did with the first anniversary, we had a live show where people could chip in and ask questions. I would love to do something similar again because this show has always been for the community. But having said that, Matt or others, if you have really good suggestions, let us know because I do believe it's something worth celebrating.
Cool. And Jeffrey has wished us both a happy and safe holiday weekend. Thank you. Same to you, Jeffrey, and your family. But he's asked us, have we ever looked at ticker symbol BX, which is Blackstone, or ticker symbol BY? I don't know that ticker symbol BY, but I do know Blackstone because I have about 5 or 6 shares in my portfolio. Blackstone are like an asset management. They're slightly different to, I think you did recently. Did you do T. Rowe Price? Or you analyze them? So they're slightly
Yes,
different
correct.
to them. So BlackRock, T. Rowe Price, Franklin Resources are all around the same. They're all more reliant on, say, your traditional asset classes like fixed equity and fixed income and so on. Blackstone have alternative markets. So if you want exposure to alternative markets, then Blackstone are probably a good bet. Personally, I would like to have BlackRock and Blackstone, so I get a whole variety of all the different asset classes. But I think they're a good company. Their assets under management are growing rapidly, which is always a good sign because in that kind of market, assets under management is like your litmus test, isn't it? Once that's
Yeah.
growing, it means people have confidence in you, and it's what you look at. So they are growing quite significantly. The returns over the last 5, 10, 15 years is outweigh the market by a significant amount. So I really like them. I think they're a top quality company. I want to add more, but again, it's a toss up between them and
Yeah.
BlackRock at the time. So no, I think they're a good company, definitely worth checking out. And also, one of my friends, he's from Canada. He runs a blog, Financial Freedom is a Journey, and he wrote an article on these. I highly recommend checking that out.
Okay, and the next question then is from Simon Stott, and he's trying to get his 9-year-old daughter into dividend growth shares, but she only wants to buy what she likes. Again, EMF, you ask your son for his opinion about Roblox.
So I did. I asked him, and I remember at the time Roblox came out, he bought them. He wanted them in his portfolio. At the time, he was a heavy user of Roblox. I mean, I think he used it all the time for multiple hours a day. I asked him about it today, and he was a little bit more coy about it. He doesn't use the platform anymore. And what he said was he thinks that it has people that his exact words was people that use it a lot, but it has a short span. So as you get older, it becomes less relevant. Now, mind you, he's 11, so he was only in that phase for about 2 years. And then he also said that he thinks it's just girls on it now that boys don't use it anymore. Now, maybe that's because him and his friends don't use it. And then I asked him, what does he think about the share price dropping 68% from its all-time high? And he said when he bought it, he was happy with the price. So at 68%, he would probably buy more. Is what he said. So it's quite funny when he said it to me. But actually, first of all, before he said that, he said, "I need to check the balance sheet again." That's what he said, and then said that. But how would I encourage my kids? Precisely what she wants to do. She wants to buy what she likes. I think that's probably the best way to get her interested. It's not going to be life changing money. I think at this moment, it's not about picking companies that are going to be around for 100 years or until she retires. Just getting her interested. If she likes Disney, if she whatever she likes, she'll be excited to have those companies. Just like my son was. So I would just let her. You don't have to buy a huge amount, buy one share, and she will naturally over time get more and more interested.
Yeah, super. I'm not able to motivate my son enough. He is a bit interested. He wants to become a millionaire. And I
Yeah.
ask him how. Well, I will become a YouTube star. And then I say, okay. And then he said, yeah, we'll get 1 million viewers when I start publishing Minecraft videos.
So
Yeah.
I went for a slight walk today in an isolated area where there was no people, and it was just me, the two kids, and my wife. And my oldest son said to my youngest, he said, "You should be investing. You should be thinking about your future. You should be doing something, right?" So this is an 11-year-old to a 9-year-old, and my youngest son just turned around and said, "Ah, who wants to waste their time investing?" It was just so funny. But
Yeah.
but he's right. He's 9. Who wants to waste their time investing at 9? So can't argue.
Well, I'm more with your son in this case.
Yeah.
Okay, then we have the next question is from Mike Plazier, and he mentioned I did a YouTube video about insurance companies, and he is asking what am I thinking about Admiral Group, and he referred to an article from John Kingham who thinks it's undervalued because Admiral Group at the moment yields 7.5%. So, that always attracts my attention, right? So I read the article and I must say the article is quite good. I'll put a link to it in the description here as well of the show. But then I went to dividend growth history and I saw like, it is not like a nice line up. That's a cut, I think, like 4 or 5 years ago. So this already distracted me. So from that point of view, I think the yield has always, or the dividend has always been high, right? There, but these cuts and such annoy me already. So in that case, I'm more interested in Chesnara. Also, what is actually really good about Admiral Group, they have a really good, how is it, underwriting of 85%. That's really, really strong. So, and it really speaks for the company that they have really good underwriting discipline. And what I also or I would say what I also see a little bit as a risk here is that yeah, really just in the motor industry, and I don't understand this industry enough. Like if you then take Allianz, it's also giving car insurance or something like that, right? And but also 10 other things, so way more diversified. And for me, anything that has to deal with cars always feels a bit dodgy, even General Motors or something like that. So, Mike, that's why I'm not interested in it, but I must say it was a high quality article, and if you feel like it's worth giving it a consideration, then you should go for it. Personally, I'm staying away for it because I got already discouraged by not seeing a solid growth path of dividends.
Cool. Dermot has asked us about REITs, real estate investment trusts. He's got none in his portfolio. He's obviously heard about realty income, but it has a very high P ratio. Is there anything we'd maybe recommend or suggest?
So I'm not suggesting here to buy right now, but one of the real estate investment trusts that I'm really bullish on the long term is Digital Reality or Realty,
Yeah.
because they are building worldwide all the data centers that the cloud companies like Amazon and Google are using. So for me, that's a perfect long-term growth play. I don't see this stopping anytime soon. I still think that a lot of shift is happening towards data centers. So I believe honestly that's a little bit on the high end of the value. It also yields only what is it, 3.2 or 3.5%. On the other end, yeah, I'm long term bullish. That's why I initiated a really small position at $150. I think it's now like a few months ago. It's now trading at 142, so below my initiation price. But for me, it was just to start following it. It's not a price that I want to buy a lot of this company from. But let's also not forget about Castellum. Yeah, in Sweden, they just changed
Yeah.
from an biannual, how is it, dividend payment to quarterly dividend payment, which is quite unique for a European company. So Castellum is also something that I could advise you at least to have a look into it. Yeah.
Okay. Cool. I think we might go two more questions, and we'll get to the rest next week. So do you want to pick the next one?
Yeah, I think Martin is one of our, how is it, really loyal listeners, and he's asking for our opinion about Novo Nordisk. And I hate that he's asking this question. He always asks me this. I mean, he's a really great person, but you know why I hate it? Because it is trading at 810 Danish crowns. I was looking at it like 1 year ago. It was trading at 425, and I thought like, 400, I'll buy it. And I put a purchase order at 400. I think one time it came even to 410, really close. Now at 810, it had really good numbers, right?
Yeah.
But it almost doubled in a year.
Is that a case of pound wise, penny foolish?
I don't know. Time
Yeah.
will tell. It just annoys me because I believe that Novo Nordisk is probably the best healthcare company, in my opinion, in the world. What they are doing with diabetes and such. Um, Better than Johnson Johnson. Of course, Johnson Johnson a better dividend grower or payer, but Nordisk, it's. I think Danish people should be proud on this story about Novo Nordisk and Novozymes. It's a really iconic company, in my opinion. Yeah, and then last question, you may choose.
Okay, and the last question then we will go with Tiago. So Tiago has asked us our stance on concentrated versus diversified portfolio. How many different companies can you keep up with, and at what point you just throw in the towel and say, I'm diversified enough or need more diversification?
Well, I touched upon it a little bit earlier, right? But if I have more than 40 companies, it's too hard for me. I think I really give 15 companies in my portfolio probably the most attention. And it's really simple. I look usually at my top 10, top 15, and that's already, let's say, 70% of my portfolio value and also dividend income. So that's where my focus should be. Yeah.
Yeah,
Mm.
yeah. I think if you get to the point of really diversified and you have maybe like an Allen or Dividend Hummingbird where you have so many companies, you don't need to worry about keeping up with them. You're just buying so many
Exactly.
companies. All you have to look
Yeah.
at is the dividend history. If they cut it, get rid of them and
Yeah.
bring in somebody else. If you have a small concentrated portfolio like us, well, ours is not even that concentrated, but if you have a smaller
Yeah.
portfolio, you do have to give it a little bit more attention into
Yeah.
quarterly numbers, yearly numbers, and make decisions on that.
Yeah, and there are people that argue, then why don't you take an ETF? But I think those people make one thinking mistake. People like Ellen and such and Hummingbird, they have like screener criteria. So in an ETF, you buy the basket all at once. And for instance, if you then have now what is the Vanguard growth dividend? I don't know what it
Yeah,
yields, but let's say it yields 1.5% now. Yeah, because you're also buying Microsoft, Apple with really low yields. But if you just always say, like, I buy only things that are yielding higher than 2.75%, you're actually every month you're cherry picking. So it's not like an ETF. You're just buying a
it
lot, but cherry picking.
it is an ETF, but it's an ETF composed of all the companies you want, as opposed to
Yep.
buying an ETF with companies you may not want.
But you cannot look at it the same because an ETF, you buy this basket every month if you would dollar cost average. Every month, the same 100 companies. And here you buy companies that, according to your screener, are, let's say, undervalued or fairly valued or something like that. So you have the benefit of keeping out the purchases when they are at a really low yield or at a high valuation.
Yeah,
So you cannot even mimic this in an ETF. And I think if you want to put in the work, like Alan and Hemingway do, I believe that's a better strategy than buying an ETF because you get the advantage of a better yield and still getting similar growth prospects when it comes to the dividend growth.
yeah, yeah. It's a tough one, isn't it? You have to commit to that strategy early, don't you?
Yeah.
You're either doing it or you're not. There's no half bake in that one.
Yes. And then you have more than 100 stocks, and then you need to do your dividend taxation filing.
I'd I'd love to see the revenue over in Ireland read
Yeah,
two
exactly.
200 stocks,
Exactly.
€2.50, $1.25.
Yeah, and I'm having that with my trading 212 pie. I'm getting like a dividend of 16 cents, and I need to translate it from euro to zlotys. And then the tax office is asking me every year, like, can you please give some documentation? And they don't know what to do with it.
Ah, brilliant. Yeah. So yeah, that'd be their worst nightmare. So we leave it that at the last question. I'm kind of falling downhill quite fast here. I'm running out of energy, so we will keep these questions for next week. I actually think we have enough questions next week. We don't have to ask next week. We still have got quite a few, so we will answer anything that we've got today. We will answer them next week. We do appreciate every single question, and we always want to answer them all. So we will 100% answer them. And thanks again for listening. I hope you, as European DJ said, I hope you enjoyed the show. Again, we're always open to suggestions, something new. If you want to give us two stocks, maybe next time we can compare them. Maybe give us two stocks where we won't agree on them. So it might be a little bit more interesting. But as always, thanks a million, and we'll see you all next week.